Hey, Joey, how's it going?
Hey, it's going well. How are you?
Good. Hey, Professor Hesh, you're on?
I'm here. I'm ready to go.
All right, Professor Hesh, I don't understand how the Charitable Remainder Puppet Trust works. Can I get 7% for my entire lifetime?
Uh, you want 7% of what?
7% of the value of the trust for my entire lifetime.
Absolutely. But interestingly, if it says if I get a distribution equal to 7% of the value of the trust. Well, if the trust only produces 4 or 5%, you still get a distribution based on the 7% value. So what that means, you have to invade principal to make up the spread.
All right, but what's my life expectancy? I'm a puppet.
Your life expectancy? I don't
Yeah.
know. Just keep away from chainsaws.
Thank you. That's a really good retort. All right, welcome attendees. We're starting a couple minutes late. We'll finish a couple minutes late. This is Alan Gassman. I'm here with Joey Kleiner and Professor Jerry Hesh. Jerry's camera is not on, but he is wearing a cowboy hat, if that makes it any better for you. And we're going to talk today about running the numbers on charitable remainder trusts, GRATs, and QPRTs. Joey is a law student at Stetson Law School. He's going to graduate this semester. He's going to take the bar exam. He's going to go to the Heckerling Institute to talk to attendees about the State View software, and then he's going to go get an LLM in tax, maybe at Boston University where Jerry teaches. So Joey, welcome today.
Thank you. Excited to be here.
Before we get started, I will mention if you came in through CPA Academy, you can get continuing education credit if you're a CPA or an enrolled agent. You have to answer, I believe, 3 of the 4 polling questions. Fortunately, you don't have to answer them correctly. You just have to answer them. If you came in through our website, then you will get lawyer credit if you're a Florida lawyer and you ask us, we'll send you the Florida Bar credentials on this course. If you have questions, go to the upside down pyramid, click on it, type in your question, and we will answer it. If it's easy enough, I'll answer it, or if it's a difficult one, Professor Hesh will answer it. In about 4 hours, or at least by tomorrow, this webinar will be posted onto our YouTube site where you can watch it as many times as you want. Our law firm earns sometimes more than $12 a month from YouTube advertising. So please click on that hundreds and hundreds of times. We'll appreciate it. Then we'll make $13 a month. The last Thursday report has good articles on the Corporate Transparency Act, so you might check that out. At 1:30, which is just 2.5 hours from now, or 12:30 rather, 1.5 hours from now, we're going to be talking about spreadsheeting and illustrating retirement planning. So if you haven't signed up for that, please sign up. If you have any problems signing up, just send me an email at agasman@gasmanpa.com and I'll get you signed up. Marty Shinkman and I are going to talk about the Corporate Transparency Act. And let's go to our first polling question. A qualified personal residence trust, is somebody running the polling question?
Yeah.
Okay. A qualified personal residence trust, A, is a trust that is specifically allowed under the Internal Revenue Code. B, it can benefit from receiving rent after the occupancy term. With a qualified personal residence trust, I put my home in a trust. I have the right to use it for a term of years, maybe that's 10 years. And then because my beneficiaries don't really have an economic benefit for the first 10 years, the value of the gift, as you see in C, is discounted by the actuarial calculation. And after the 10th year, I can start paying rent, which gets more assets out of my estate and more assets into the QPRT. The correct answer here is all of the above. And Anthony, what percentage of people have answered? 84%. 16% are walking their cat outside, getting their toast and muffins ready for breakfast, or drinking a Bloody Mary. Let's go to the next slide now. All right, Joey, do you want to take us through just 3 or 4 minutes on QPRTs before we run some numbers?
Sure. So QPRT is a qualified personal residence trust. It's a trust that helps get your house out of your estate. So the personal residence is either your principal residence as the grantor, the person who's setting up the trust, or one other residence that you own as the grantor. You can also put in a undivided interest in either of those residences into the trust. So one common thing that we do is split a trust and put in maybe half from one spouse and half from the other. And that way you can take a discount on the value of the house, because only owning half the house is not as valuable as owning 100% of that house. Alan, can we go to the next slide?
Sure.
So the QPRT, are we still sharing the screen here?
We should be.
I don't see the slides.
There we go. Sorry about that.
No, I see.
There we go. So going on with the QPRT here, you can only have up to 2 QPRTs at one time. So again, that's going to be your principal residence or one other property, and you can actually have 2 separate QPRTs for each of those properties. Now, I think we're good on this slide, Alan, if we keep moving.
I'm going to move way past.
All right.
I want you to talk through some numbers.
Sure. So
Let me make one comment.
Okay.
The QPRT, you're entitled to use the residence without having to pay any rent for a fixed term, say 10 years. After the end of the 10 years, you're no longer entitled to the free use of it. So Alan mentioned the trust now owns the residence free and clear of your right to use it. And the only way you can continue to use the residence, which the trust now owns, is to rent it back from the trust. And when you pay rent, it further depletes your remaining assets. The problem is if you pay rent, then the trust will have to report income, rental income, for income tax purposes, if the trust is a separate taxpayer for federal income tax purposes. But what happens, Joey, if we, after the end of the QPRT term, we can continue the trust as a grantor trust for federal income tax purposes?
right, yeah, you can definitely have it switch after that term. Alan, do you want to add?
And then there's no tax on the rent, because for income tax purposes, it's like you're paying the rent to yourself.
So you want to make sure that, remember, during the QPRT term, it's automatically a grantor trust. But you have to put in a provision in the trust agreement to continue it as a grantor trust after the end of the QPRT term. Because if you don't have it, it becomes a separate taxpayer. Then all of a sudden, the trust has to report rental income. And since you're paying rent on a principal on a residence that's not a business, you don't get a rental deduction. So you're creating income for income tax purposes if the trust becomes a non-grantor trust. So you have to be very careful at the end of the QPRT term.
So you could give the spouse the ability to replace assets with assets of equal value. Make sure that that power exists after the QPRT period runs.
Yeah. Oh, and by the way, an interesting thing is, if we continue it as a principal residence, I mean, it's your principal residence, and at the end of the QPRT term, it stays as a grantor trust. So, and if it stays as a grantor trust after the QPRT term, for federal income tax purposes, the grantor is still deemed to own the principal residence for income tax purposes. And the question then becomes, if they sell the trust and have a gain, can they take advantage of the exclusion from gross income that excludes up to $250,000 or $500,000 of gain from the sale of a principal residence?
And the answer, Joey, is?
We're putting them on the spot
The
there.
grantor, I'd say yes, they could take that exclusion.
You got it right.
All right. See, Joey, you're learning a lot as we go along. So don't get nervous if we keep peppering you with these questions.
No, I like questions. That's how I show that I learned something.
Right. All right, so let's run some numbers here. I'm using the Estate View software, and if you want to use it, it's free at this point. You go put in your browser estateview.link in your browser, then you click on it, then your name is test at test.com, all little caps, TEST ampersand, I'm sorry, at test.com, and your top secret password is test. And then when you get on there, you could click on under the calculators on QPRT. And what we start with in the calculator is what Jerry requested as a super simple QPRT calculator, and we call this the Swift plan mode.
Oh,
So
let me point out one thing. One of the problems when we're talking to clients is they don't speak tax. You know, they might not what a QPRT is. And the key is, what clients want to know is not how wonderful these are to save estate taxes. They want to know how much money in estate taxes I'm going to save. And the nice thing is of what Joey is going to show you is how to communicate how much money you can save using simple to follow numerical examples, so you can communicate to the client that here, using certain assumptions, this is how much you're going to save in estate taxes. And that's what the client really wants to know, is not all the technical details, but you want to illustrate those, how it works, so they can see how much you're going to save in estate taxes. That's the first question they ask. All right, go ahead, Joey. Okay,
I'll be Joey for a minute. So on the left-hand side, you have your inputs. It tells you that the 75/20 rate is 5.6%. That's the rate, that's the actuarial table rate you're using. We're going to do one life here. The person is 70 years old. The term of the QPRT is going to be 10 years, and the value of the house is $2 million. Across the top, you see that same information again, and then it gives you the results. And the most important result is that 42.461% of the house is a gift. So that gift is $849,225. This person puts the house into the trust, only uses $849,225 of their $12,920,000 estate tax exemption. And whatever this house is worth after the 10th year will be out of their estate for estate tax purposes. If the trust is drafted properly, then if the home is no longer being used during the person's life, let's say they've moved somewhere else, they don't want to use this home anymore, or they sell the home, then for the remainder of the 10-year term, the trust will pay the donor $171,979 a year. So that basically the QPRT becomes a grantor retained annuity trust. If the client has a creditor problem and lives in a state where annuity payments are creditor proof, this could be a nice issue. So Jerry, this is what the standard calculation on QPRTs using standard software does. Do you have any comments or questions on this?
So essentially, a QPRT basically says all future appreciation in the value of the house is now allocated to the trust. The trust is not in your estate, and they're the owner of the house. So as a result, you basically have frozen the value of your property at its current value, and all future appreciation in the value of the house will no longer be exposed to estate tax because the trust is now the owner of the house for transfer tax purposes.
Right. Now, I'm going to click the button here called duplicate on the left-hand side in green. And what it's done is it's replicated another QPRT with the same exact numbers as QPRT 1, but I can change something. For example, if I do a 14-year QPRT, I can click up to 14 years. Now you see, and by the way, if I click on these cells, I can turn them different colors. So you see the difference here between these two QPRTs is 10 and 14 years. And the difference as to the gift is significant. It's an over $300,000 difference. But the question is, will the person live to the 14th year? Now I could do another one and show 8 years, just for the sake of doing that. So that is the Swift plan mode.
Now, Alan, before we move off the Swift plan here, I just want to make sure I'm understanding the value from a QPRT. So you have this $2 million residence that you place into the trust, and then at that year you get a gift tax exemption. You use part of your lifetime exemption, but you don't use $2 million of your exemption, even though you're gifting the house to another entity.
That's
So
right.
You're almost saving that difference between the gift, and the amount of that savings changes based on how long the trust term is.
Right. Now I will show one more thing. I'll show a QPRT number 4, and QPRT number 4 will be a joint QPRT. Now I've never used a joint QPRT. I think that Larry Katzenstein does. But if the married couple, they're both age 70, well, we could say 170, 168, 160. Now the gift amount is a lot more because there's a greater chance that they'll live the 10 years. But they could go 14 years, and when you have two people going 14 years, it's more likely that they'll live. Jerry, have you done joint QPRTs?
No, I haven't. Mainly because it's a little bit more complicated. But the point is, the client says, wait a minute, the longer I retain the right to live in the house, the less my gift is. So why don't I basically retain the right? I'm 70 years old. Why don't I retain a right for 20 years? And my gift will be even lower. But what is the problem if you happen to die within the QPRT term and you're retaining a right to use the trust assets for a period that lasted for the rest of your life? What is the problem if you die during the trust term, Joey?
I believe when that happens, when the grantor passes away before the term ends, the QPRT basically is undone. So then you lose that gift exemption and the house goes back into your estate.
At its value at the date of death, so it's significantly appreciated. So what this program allows you to do is show the client that what they're doing is estimating how long they're going to live. And you can basically say, you want to reduce the amount of the gift, there's a greater risk that the full inclusion will be included in your gross estate. So as a result, the idea is that you want to have the client make the decision as to how long the retained right to live in the house should last, and you help them make the decision by illustrating the different estate tax and gift tax impact. So
Okay,
it's a
so
way
now
of, yeah.
I'm going to go ahead and click out of the Swift plan mode into the standard mode. And now it's showing me some other information. It's using the same information I had, but it's showing me a little bit more information, including the life expectancy. And this is really interesting. The life expectancy of a 70-year-old, according to the standard tables. Now, most people live longer than the standard tables. The standard tables include smokers and people of lower economic means who don't get the same kind of medical care. But the 70-year-old's life expectancy under the standard tables is 15.4 years, which means that at 15.4 years, half of the 70-year-olds will still be living and half of them will be deceased. A 10 years seems pretty safe. But a 14-year maybe not so safe. But the life expectancy of that married couple is 25 years. That's really interesting. So the other thing that this is now telling me is that I am illustrating death in year 15 and what happens to the family on a 30-year basis. And I see here, this column, here's the probability of surviving the number of years. And we're going to move this column over next time. It should be right after the life expectancy column. But you see that there, when you see an 80–90% chance of surviving, then that's a term that I am comfortable with. And then let's show you what the new assumptions are. So on the left-hand side, when I clicked from the Swift plan to the standard plan, now I can enter the exact date that the QPRT was formed. Now I can enter the life expectancy of the person, automatically comes up. Now I can enter what year of death we want to illustrate. I can enter the number of years I want to illustrate. And you see the blue line there across the left gives me all the new data that I can illustrate. And then I now have a spreadsheet. Now this is the spreadsheet for QPRT 1, if I want to see the QPRT 1 spreadsheet, QPRT 2, QPRT 3, QPRT 4, QPRT 5, and I'll go to the QPRT 1 spreadsheet. So you have the 70-year-old, you've got the probability of death each year, you've got the increasing value of the house, you've got the growth in the house, but it's not showing any rent. So I'll go to the advanced version. And I will show rent at 7.5% of the value of the house each year. And then the rent paid is going to grow at 6.75% interest. So now, and I can show every other line so that it fits better. So now you see in year 14 that year 15, this house is going to be worth $3 million, and the cash from the rent hasn't really started yet. The amount of estate tax savings, though, if he dies in year 15, is $1,128,000. But when you see with the rent, by year 30, the savings would be that much more.
And
when I go,
what happens is a lot of programs, all they do is show you the impact of the value of the house at the end of the QPRT term. So if the house was worth $2 million when you put it in, and it was worth $3 million at the end of the QPRT term, they say, hey, we just shifted $1 million of value out of the estate with no estate tax. So at 40% estate tax on $1 million of value, you save $400,000. But what you want to do is also show, if you're going to continue to rent the house, which they probably want to do, you have to take that factor into account, which increases the estate tax savings. And also, you also want to illustrate not the estate tax savings when the QPRT term ends, because the individual is still going to be alive. You want to show what the value will be when the individual dies, because that is the real estate tax savings. And this is what the program allows you to do.
Right. So now I'm showing less columns across the top, so it's easier to use. All I did was I hit alter summary columns, and I decided what's going to stay in the summary. But what if this 70-year-old has 2 children? Jerry, what if this 70-year-old has 2 children and decides to put half of the trust, half of the house for child 1 into one QPRT and half of the trust into a separate QPRT for child 2? What happens then?
Well, are they going to stay as grantor trusts, I take it?
Yep, they would stay as grantor trust, but is half a house equal, is half of a $2 million house worth $1 million?
Oh, of course, that goes to that goes to the gift up front.
Right. So if I give half the house, which I'm showing here, then the amount of the gift is that much less, significantly less than half of what the gift would have otherwise been, and I can put these in green.
Yeah. For example, the gross value of the entire house is $2 million. A half interest in a $2 million house means that you really don't have control, absolute control. So you can basically say a half interest on a $2 million house is not worth $1 million. It's worth something less, maybe $800,000, because you really have no control. So essentially, right, in determining your gifts for gift tax purposes, when you create the trust, Alan's saying is have 2 separate trusts, each with a non-controlling half interest. So in determining the gift, instead of using $2 million, we're going to use 2 $800,000 gifts, or 1.6 million.
Right. So line 5 is the entire $2 million home with $1,987,000 of estate tax savings. Lines 6 and 7 are half of the home each with $1,009,000. So the estate tax savings goes up a little bit. It's not a tremendous amount. Now, I'm not leaving enough time for the other things. But one more thing I'll do on QPRTs, running the numbers, is just for so we have them. I'm going to prepare a PowerPoint explaining each of the 7 QPRTs. So I'll just click all 7. I will click on PowerPoint presentation. I'll click submit, and now it is preparing all 7 PowerPoints. So, and we can send this to the audience. So if you want to see the PowerPoint on QPRT number 7, there it is. And it gives all the facts and the information and the spreadsheet and everything on QPRT number 7, so you can send that to your client. So that's.
So that means automatically, if you want to use a PowerPoint illustration to explain this, it does it for you automatically?
Automatically, that's right.
Wow. But here's the next question. What if the client wants more of a written explanation and not a PowerPoint?
Well, then you would click explanation, short and general, submit it. There is a short explanation that you see right there on each of the QPRTs to help you remember where that came from. And Jerry, I think you're going to be helping me write this better. And then here is a word explanation, generally describing QPRTs, which by the time we release this, hopefully in January, this will be a more customized explanation.
So essentially, the PowerPoint and the general explanation, the written, can incorporate the numbers that the particular client wants to adopt.
Right. Okay,
that
Joey,
saves a lot of time.
It does. It does. Okay, so I need to do a polling question. or everyone's going to desert us. So what is the next polling question? Line 96. So here is the next polling question. A charitable remainder trust provides a tax deduction now for what a charity gets later. Because I could put $1 million rental building into a charitable remainder trust, and I could receive 11% of the value of that trust every year for 20 years. And then the trust could sell the rental building, and I wouldn't have to pay income tax on the sale because until I get my money of 11% a year. But when I do that, I'm going to get a tax deduction. In my example, I'm going to get a tax deduction equal to about 10% of the value of the building. B, I'm going to have deferral of income from the sale of that building. C, I'm going to have recognition from a charity for doing something now that doesn't really help the charity for 20 years. And then D, the best answer, is all of the above. Anthony, what percentage are we at? We're at 87%. This is a fast crowd.
All right.
So Jerry, what can you tell us about a charitable remainder trust before we look at some quick numbers?
Well, there's two things. One is a lot of people have charitable inclinations, but they don't have an extremely high net worth. Let's suppose you have a couple who have $6 million of investment assets, and they need all of the income from the $6 million for the rest of their life to provide for their living expenses. So, but they say, when my surviving spouse dies, I like to have $1 million charitable bequest in my will. And they can't afford to give the charity the $1 million today because they need the income from the $1 million. So you have a lot of clients, I call them clients who are not exposed to estate tax. They're under the 6 million or 12 million exemption, who have charitable bequests in their will. The problem with a charitable bequest in your will is you get no income tax deduction. But if you put that same $1 million into a charitable remainder trust, which says I retain the right to receive all the income from that $1 million for the rest of my life, and then when I die it goes to the charity, you get a current income tax deduction of maybe $100,000 or $200,000 or $300,000, depending upon the terms. So essentially, you're getting the practical equivalent of a charitable bequest because you're getting all the income from the property in the charitable remainder trust, but you're also getting a charitable income tax deduction equal to the present value of the charity's future interest. So a lot of people who are not charitably inclined while they're alive, you could show them, why don't you do this instead and still have the benefits of the financial benefits of all your assets.
That's right. And Jerry, you can elect to receive a percentage distribution for life or a percentage distribution for up to 20 years.
Right. In other words, if I put an asset into a charitable remainder trust for my life, and the charity gets everything in the trust when you die, and they're worried about, well, what happens if I die unexpectedly 2 or 3 years out? Who gets all the property? And I say, the charity, but you don't need it. But they say, no. So what we do is, if they don't want to take the risk of dying early, you can basically tell them you can do a charitable remainder trust for a fixed term up to 20 years. So if I retain a right to all the income for a fixed term of 20 years, that is a very valuable asset that does not terminate when I die. So if I die in year 12, I have the right to the remaining 8 years of income from the trust. So that's one way of a sage, telling them, if you're worried about dying early, we'll do it for a fixed term.
Right. and you have to be receiving at least 5% a year. You can't receive less than 5% a year. Is that correct, Jerry? And then
in other words, basically, they have certain technical mechanical requirements. In other words, if I have a $1 million asset and I want a fixed payment, it must be a minimum of $50,000. If I want to receive a percentage of the value of the assets in the trust, the percentage cannot be less than 5%. And the reason for that is because people were playing arbitrage games, but we're not going to get into the technical. So if you're going to do a charitable remainder trust, there's all sorts of technical requirements that you have to be aware of. And that's why the advisor comes in and can give them that advice. All right.
Right. I'll just mention for 20 seconds that there's something called a flip NIM-CRUT where you don't have to take payments until later on, so you can defer the income tax. But let's go ahead and take a look at some numbers here. I'm in the Swift plan mode, but what I did was I went to the calculator called Charitable, the CRUT calculator. It put me into this mode. So the first thing it tells me is that the 75/20 rates, look how they're going up. September was 5%, October 5.4, November 5.6. You can pick the rate of your choice for a CRUT for this month or the previous 2 months. It's best to go with the highest. So it is automatically selected use of the 5.6% 75/20 rate. I've got a 64-year-old. You can use the calendar to decide the age. Do I want to minimize the payout rate? If I click yes, then it minimizes the payout rate. The minimum payout rate, I can slide here, would be 5%. Yeah. The maximum payout rate would be 17.02% if I go for life. If I go with 20 years, I can click term and I can go to 20 years, and then the payout rate every year is going to be 11.48%. I can schedule for annual, monthly, quarterly, or semi-annual payments, and it will calculate what the payment is for each of those. I can put in the number of months that it will be due before the first payment, and then here we're assuming a $1 million contribution. So across the top, it's telling me the technical numbers I need to know. It's telling me that I gave the charity at least 10% of the million, so I have passed that test, and what the payout rate will be, 10.866% of the unit trust amount each year.
Now, let me point out something. You basically, that 10% or whatever, or $100,000 was nothing more than the present value of the charity's right to receive this in the future, correct?
That's right.
And if I want to maximize, in other words, if I have a percentage of distribution that's greater than the income the property produces, I'm going to be invading principal. Okay, and therefore the charitable remainder calculator takes into account how much a principal is going to be depleted during the term and what's remaining. So therefore, if I retain a 5% unit trust percentage for someone age, go back to life, Ellen.
Okay.
Okay.
Life here.
Yep. All right. So we have someone age, and what was their age you used?
64.
So someone age 64. Okay. So if they retain a right to the, say, a 5% distribution every year, okay, what would the charitable income tax deduction be? And you see it's $412,000 because it's basically assuming you're not going to be invading any trust principal. Okay, the higher the unit trust percentage, when it starts to exceed income from the trust, you're going to be invading principal. So there's less principal that will be available upon the death of the individual. So basically, if someone only wants the income from the property, you would use lower unit trust percentages or lower annuity amounts to maximize their charitable income tax deduction for the value of the charitable interest that goes to charity in the future. Now,
Right.
Joey, let me ask you a question here.
Sure.
Pretend we're in class and I called on your name and it was on the seating chart, all right? And all of a sudden you start to panic because the professor called on me and you weren't expecting this, all right? So pretend we're just in class, Joey. Don't get nervous, okay? Okay. The IRS is required to use the mortality tables that are required in the Internal Revenue Code, all right? And those mortality tables basically are based on the United States Census data in the year 2010. So we have mortality tables that determine life expectancy of individuals 13 years ago. They also determine the life expectancies using the United States population as a whole, which includes everybody, including homeless people or people who don't have good health insurance. So essentially, they use the life expectancy of the aggregate. So we have tables that are 13 years old, tables that basically understate the life expectancy of wealthier people because they have better health care. So does the tables overstate the present value of the charitable remainder interest?
Overstate. I would say it does, because most people setting up these charitable remainder trusts are going to live longer than that. So they're going to continue to collect their payments longer throughout their lifetime.
Right. So essentially, if someone has a life expectancy under the tables of 15 years, remember, it's only a 50% probability they'll be dead.
Mm-hmm.
And even if they expect to exactly die at their life expectancy, it's much greater. So essentially, the present value of the charitable remainder interest is assuming that the charity is going to get the property, say, 15 years out, when in reality, the charity is not going to get the property until maybe 20 years from now. So the income tax deduction that you get, because it assumes shorter life expectancies than it's going to be in reality, it overstates the value of your charitable income tax deduction.
Which is a great thing.
Right, and that's because of the 75/20 rate that we use to project
No,
that?
because of the mortality tables that you.
Mortality table. Yeah.
Okay.
All right, so now I'm going to go ahead and just show what else we could do here. So let me see. So everything, yeah, everything in blue.
Alan and I can't do this the next time. Do you think you can do it all by yourself?
I can definitely try. It's always fun to be on here and chat with you guys. I know we are at about 15 minutes left.
Yeah.
So, Alan, I'm gonna let you.
So again, I can run a spreadsheet now for each of these CRATs, and I can do a timeline showing the client what happens to the CRAT assets, what the growth is, what comes out to the client, and how each of these three different CRATs will act over time to help them decide what they're going to do. So now I'm going to go back to the PowerPoint, and we are going to.
Here's the point: every one of these has to be custom designed based on the individual's expectations of how long they're going to live and what rate they're going to get. And by having the ability to change the numbers instantaneously, it helps them reach a choice of how to custom design it. That's the most important thing. All right.
Okay, so now we're going to do polling question number 3. Thanks for everybody for staying with us. We're getting a lot of great questions. A lot of them we're just going to answer by email. But the grantor retained annuity trust allows me as a donor to put assets in a trust. I get payments back, and what's left in the trust at the end of the payment term is out of my estate for estate tax purposes. So if I could put $1 million asset in a grantor retained annuity trust and get back payments of $1,200,000 over 3 or 4 years, I've made a very little gift, if any gift at all. But if the assets perform well, what's left after that term will be out of my estate. And in the meantime, I'm able to pay the income tax on behalf of the trust. So here's the polling question. GRATs work well when A, large asset amounts cause possible gift tax exposure if you make a gift to this thing, which we'll explain in a little while. B, the clients want a simple way to exclude growth from their estates. C, if the clients don't want to file a gift tax return, you could zero out the GRAT, so there's no gift tax. And D, they can work very well with high income S corporation and partnership interests. When you run the numbers, the results can be fabulous. Anthony, what percentage have answered? 80% have answered. 20% are in the bathroom. Jerry, what did I miss on the description of the GRAT that you'd like to clarify?
A GRAT is nothing more than a sale of an asset to a grantor trust for an annuity for a fixed term. And so what a GRAT is really is nothing more than selling your asset to a trust for a deferred payment obligation in the form of an annuity. So if I have an asset worth $1 million and I get an annuity, say for 10 years, the annual annuity payments will have a present value of $1 million. So essentially, I'm selling my asset to the trust worth $1 million, and in exchange, they're giving me an annuity worth $1 million. So what that means, very simplistically, is if the asset appreciates in value, I don't own it. I sold it to the trust. So a GRAT is a way of shifting future appreciation in the value of the asset to the trust by selling it to the trust for an annuity. And because it's a grantor trust, there's no sale for income tax purposes, so you don't have to report any of it. So that, now, the reason, so if I sell an asset worth $1 million to the trust, and they have given me an annuity worth $1 million, I haven't made a gift for gift tax purposes because I gave them an asset for $1 million, worth $1 million, and they gave me an annuity worth $1 million. So essentially, there's no gift for gift tax purposes, so you don't have to use any of your gift tax exemption. You can save it for property that you own at the time of death. That's simplistically as a GRAT.
Okay, so page 125, this person puts $4 million worth of assets into a GRAT. The GRAT gives him back $1,913,000 worth of assets at the end of year 1, $2,296,000 at the end of year 2. That is required payments back to him. This is considered to be no gift at all based on the 75/20 rate as of the month when this occurred. But if the assets would grow at just 10%, at the end of the second year, there would be $438,000 in the GRAT that would escape estate tax. Now, that $438,000 could benefit the spouse if it is a SLAT GRAT, or it could benefit descendants. It cannot benefit grandchildren very well because of the GST taxes for a large family. That's the big drawback of the GRAT as opposed to an installment sale, is that with an installment sale trust, what you end up with can be GST exempt. With a GRAT, not so much. So
using
go
this example, Alan, the present value of the two payments are exactly $4 million. So
Right.
essentially, but I made no gift for gift tax purposes. But at the end of the 2 years, after I paid those two annuity payments, there's $438,000 left in the trust. And for generation skipping transfer tax purposes, I would have to use 438,000 of my GST exemption, so to make that to eliminate its exposure to the GST tax.
Right. So Jerry, how would we illustrate 2-year rolling GRATs? Would we just guess on what the 75/20 rate is going to be?
You use the 75/20 rate for the date the trust is created.
Right, but if I want to illustrate 10 years of rolling GRATs, of 2-year rolling GRATs.
I got to make an assumption of what interest rates will be in the future.
Right.
Now, interestingly enough, it's a question of, should you do 2-year rolling GRATs, or should you do a GRAT, say, I don't want to bother with that. I want to do like a 10-year GRAT. What's the problem, Joey, if I did a GRAT for 10 years and I'm 80 years old?
Well, you might not live the whole 10 years.
And then it's in your estate. So you have that same issue with the
QPRTs.
Yeah.
You always want the GRAT term to be a term that predicts you will still be alive at the end of the term.
Right. So here on estate view, we have to use the 75/20 rate for the month. Then I'm showing a 10-year level payment GRAT, assets growing at 7%, starting with $1 million. And this shows that in order to have zero gift when the GRAT is set up, we want the annual payment will have to be $133,305 a year.
Oh, that's for a 10-year term, right?
That's for a 10-year term. And then if the assets grow at 7%, it should be worth $125,351.
Actually, I'll make it a little bit simpler. Let's suppose that the assets grow at the same rate of return as the 75/20 rate. In other words, the income produced by the assets in the trust is 5.6%.
Yep. Now there's nothing left at the end of the 10th year.
All right. So essentially, the present value of the right to is the present value is based on the income that you retain, and if the annuity that you retain only equals the income it's going to generate, the present value of the remainder interest, which is your gift, is zero. But in reality, you're only depleting income, not principal.
That's right. Now, the other thing I'll show here is the third GRAT. I'm going to go back to a 6.5% rate of return. I'll type in 6.5% rate of return. But you don't have to have equal annual payments. The payments can increase each year by as much as 20% a year. So when I do that, I see that at the end of the term, I have more in a GRAT that increases payments. So you would always want to increase payment over time. The only time you wouldn't would be if the client's going to be confused by that. So now I'm going to go from simple to our standard mode, and another nice thing we can do with the GRAT is give a discounted asset. For example, you may have an LLC with $1 million of assets in it, but if you give a 99% non-voting member interest, then maybe even if you only take a 10% discount on that, now it's really considered to be a $900,000 gift. And look what's left in the GRAT at the end of 10 years, $980,000 just from taking a 20% discount. So that is really, you know, where the GRAT is at. And that would be why you would want to take a longer GRAT term so you could justify the discount. It's hard to, you know, if you have an LLC that's worth $1 million and it's going to have to pay $1,100,000 out in 3 years, it's really hard to take a discount. But I would think that just a 10% discount makes such a difference there. And then of course we've got the spreadsheet that.
So essentially you can show the client, this is how the money accumulates in the trust each year. And what happens is you show at the end of the GRAT term, after all the annuity payments are made, the GRAT doesn't have to pay anything more to you. Look at what's left in the trust without any estate or gift taxes.
That's right. And then another thing I just want to show you, Jerry, is, a lot of times we're working with a business. The business is worth $1 million, but it also sprays out income of, say, $50,000. So in addition to the fact that it's growing at 6.5%, the business itself, the $50,000 is going into the GRAT. So that is GRAT number 4. And just that little $50,000 difference, well, I must have done something wrong here, because now it's showing a remainder interest of 10 million. So I've got to go back to Kevin, the programmer, and ask him why that little difference would have made such a difference. All right. Then the same thing, I can go to general explanation, and I can click on the 4 GRATs that I just did. I can click on a planner's checklist, PowerPoint presentation, and even sample provisions that we're providing. Then those all go up into your browser, and we've got in Word your sample provisions that you can check out, see how that compares to what you're doing. And also in the browser, we've got the 4 PowerPoints and the planner's checklist. So Jerry, we've got about 2 minutes here, and we could maybe go over an extra 5 minutes. Anything you want to say on GRATs, and then we can answer some questions.
Well, I basically want to go over general principles of all estate planning techniques. Number 1, besides an outright gift, if I have an asset that I want to retain the right to the income from, I actually sell it to a trust for a promissory note. That promissory note can be an installment note, or it can be a GRAT with a retained annuity. And basically, the trust then owns the asset. So any appreciation in value is shifted to the trust. So we call that the freeze. We're freezing your wealth at its current value. Number 2 is, especially with interest in closely held businesses, the actual market value is not necessarily the price you have to use, because what we do is we have it in a limited partnership interest or a limited liability company and a non-voting interest, so we can take a valuation discount for lack of control. So if I have an asset that I could sell for $1 million, but I have a non-voting interest in that asset, say, I can discount it, say, by 20%. So in reality, I'm not selling an asset for $1 million, I'm selling it for a promissory note of $800,000. So the the freeze for future appreciation. The second factor you have is the valuation discount. The other factor is very simple, and it's financial leverage. If I have an asset that's producing, say, 7% annual income, and I can sell it in a deferred payment sale to a purchaser for 5.6% interest on the note, and it's earning 7%, I keep the spread. So I keep the extra 1.4%. So I'm also basically, beating what I call the hurdle rate. And then what is the fourth factor, Alan, that also depletes wealth that your programs illustrate?
The grantor's payment of the income tax on the income of the trust.
All right. And we'll leave that to our law student to explain it at another time.
So the final polling question is, we are looking for beta testers. If you'd like free use of Estate View software, A, of course, B, maybe, C, heck no, or D, I'm sorry. What was the question? How are we doing, Anthony? Okay, all right. Very good. Joey, any questions here you see that you think we should answer for 5 minutes or so?
Sure. We had a couple at the beginning regarding when you can change the term of a trust. So can you change the term of any of these 3 trusts we talked about today after they're set up?
I don't think so. No, they're set in stone. That's a good question.
So the reason you want to be able to illustrate all sorts of different situations is so that the client can actually custom design the term of the trust to accommodate what their concerns are, rather than having to say, can I change the terms? Can I change the length of the trust in an irrevocable transfer? And the answer is, we want to give you all the financial information up front and show how it works, so you can custom design all the factors that go into the trust to accommodate your personal needs and desires.
Okay, next question, will we send slides later? Yes, we will. I apologize if we didn't send them yet, but we will send them later. The next question, does the software illustrate a rolling GRAT? Not yet, but it's on the list. It should early next year. Can mortgage property be placed in a QPRT? The answer is yes, and the grantor can agree to be responsible for the mortgage, and then the mortgage can basically be ignored for purposes of the QPRT management.
No, actually, if you put an encumbered residence into a trust and into a QPRT, and the grantor says, I'm going to pay the principal and interest on the mortgage every year. Well, remember, the trust owns the property. So legally, it's the trust's obligation. And if the grantor is paying the principal and interest on the trust mortgage, how is that treated for gift tax purposes?
It's treated as a gift on the day that the grantor donated the property and agreed to pay the mortgage. There's a private letter ruling on it.
Yeah. In other words, there's no freebie there. Because remember, no. It's the trust obligation now.
Right, right. Okay, then one person is saying, do you think 80% chance of survival is a good point to choose for the term of a QPRT or the term of a GRAT? I'm generally comfortable with 80%. I like to show the client, here's what the numbers would be if we go 70%, here's what the numbers would be if we go 80%. If the client's fairly young and it's a 10-year QPRT or a 10-year GRAT, you could just buy a 10-year term life insurance policy to overcome the term. If you do 2 QPRTs between a husband and wife, take a fractional interest discount on both of them, how concerned am I about the reciprocal trust doctrine? Well, when we do that, one spouse has the withdrawal power over the other, over one QPRT, but not vice versa. So if Marcia and I both did QPRTs, the QPRT I set up for Marcia would be for her and our descendants. The QPRT that Marcia sets up would be only for our descendants. And you almost wonder, do I want to do a QPRT that benefits Marcia? Because then she won't be able to pay rent to that QPRT. So you might not even want your spouse to be a beneficiary, or you should at least have a trust protector who can remove your spouse as a beneficiary in case it's better for your family that the spouse will pay rent. I'll do a final question. What else does Estate View do? I don't want to go through an entire thing. I just want to show you a couple things that Estate View is now doing. When you click on news here, Estate View will give you up to 7 news feeds. So I can click on 7 here, and then I can click on my favorite news feeds, Yahoo Finance, Forbes Money. I like New York Times estate planning articles, and then it can show me summaries of each article, and then show me the authors of each article, and it updates every 30 minutes. Across the bottom, you can pick a ticker tape. Eventually, Jerry, I want to have a chat column, a live chat column with a moderator, so that subscribers can exchange ideas and details. Another thing we have now is a life insurance estimator. You click on life insurance estimator, and you click to the age of the person, and it tells you per million what the normal cost of that would be for a standard non-smoker or preferred non-smoker, for term life, and also for a universal life per million. If you wanted to buy 3.5 million, I can put 3.5 there, and it gives me the rates for 3.5 million. We don't sell life insurance. We just want people to be able to get some approximate pricing. So while they're working with their estate planner, they've got some approximate pricing. Another thing we have is an amortization calculator that's a little bit different than the others, because it allows you to solve for the payment amount, which is normal, or you could put in everything else and solve for the number of payments, or you can solve for the interest rate or the principal amount owed if you just give it the other 3 items. And Joey, you programmed this one, didn't you?
Yep, I definitely helped with that, but of course, getting the review from Kevin, our main programmer, was super helpful.
Right. So then the installment sale, Jerry, this is what you were most recently working on with Brandon, showing the spreadsheet of the installment sale both to the grantor and to the trust, showing the effect of the paying the taxes. And we did add in a discount for the first year gift. So this can also be used as a just a gift calculator. We're going to fancy this up and allow gift splitting and annual gifting as well in a separate module. But that's all for today. I want to thank everybody. I apologize. We went 5 minutes late, started 2 minutes late. We had some technical issues. We want to thank everyone for participating, especially thanks to Professor Jerry Hesch, who's been a tremendous mentor to me and hundreds, if not thousands, of tax and estate planning lawyers over the years. Jerry, anything final goodbyes here?
No, just the thing is, our objective is to give you a tool to allow you to communicate technical techniques in an understandable manner. It's not what you know, but your ability to explain it.
Right. So any reviews you have, any criticisms you have, will be very much appreciated. We're going to see hundreds of you at 12:30 with Kevin Miller. Jerry, if you'd like to stick around for that, just keep your camera on, keep your computer on, and we'll talk to you in about 21 minutes. Everyone else, have a fantastic, great weekend.
Alan, can you still hear me?
Yeah. Mm-hmm.